Hey guys, when you're ready to make the leap from duplexes and fourplexes to multifamily and commercial deals, you need to understand some of the nuances of a commercial mortgage versus a standard residential loan. Residential loans are pretty much cookie cutter loans by most banks. You have your interest rate and terms, and it's pretty much it. But if you want to get into bigger deals, like say 5 units or more, you're now needing to get into the commercial loan space when you're talking to these lenders. In a commercial loan, the lender is looking at the asset and its ability to cash flow. So this allows for much more flexible financing options. There are 5 areas that a lender we're going to look at to make sure that you have what it takes to get that loan. So make sure you have these 5 buttoned up before you go to that bank and make your pitch for a loan. Number 1, your credit score. Unlike a residential loan where your credit score is one of the top considerations for them to give you a loan, for most commercial banks, it's not the top consideration. Keep in mind that the bank is looking at the property as a cash producing asset as opposed to a house that actually costs people money to own. However, you still want to have a good credit score. You want to keep it above 600. Anything lower will cause the bank to ask questions and start asking why your score is so low. So keep your balances low, and that'll help keep your score up. Number 2, your ownership management experience. Your commercial lender will want to know about your experience in managing and owning other properties. This is a major sticking point since they want to know that the property will be run profitably to cover the note. If you own a handful of single family rentals and duplexes today, that's pretty good experience and you can bring that into play. It attests to your ability to run smaller deals. If the plan is to go way bigger and more than what you've done traditionally, you may want to lean on the background of a strong property management company and their experience. All right. If you're looking for smaller deals, like say 5 to 50 units, some lenders may allow you to self-manage. However, you need to demonstrate that you have that previous management experience and you know how to underwrite those tenants. You need to know how to check if they have a job, check if they have good income, criminal background, etc. They understand that you'd want to self-manage because the margins in these smaller deals are fairly small. So just bear in mind that the ownership experience is much more valued than the management experience. Or they're always looking at that. You want to make sure that you are a competent owner. Number 3, net worth. The bank is going to look at your overall net worth, which is the difference between your assets and liabilities. They're looking to see whether your net worth is equal to or greater than the loan amount. So, for example, let's say you want to buy a $1.5 million building and you get an 80% loan to value. So the bank is going to want to see that you have a net worth of about $1.2 million. This doesn't necessarily mean you're out of the game if you have lesser than that. Let's say you have $800,000 of net worth, but you have good income. That may be enough to get the deal done. Again, it depends on the lender and their comfort level. Number 4, income. Whether you're a W-2 employee or self-employed, if you have income, that lender is going to want to understand how much personal income you have, including the income from your other properties that you own. Now, they're looking for your global cash flow. They want to know that if one of your properties has an issue or starts flaking out, you still have the debt obligation under control and you can still make the loan payments. The bank is not looking for a ratio on your global cash flow per se. Instead, they're looking for the property's loan to value and debt coverage ratios, what they're looking for. They want to know that the NOI will exceed the monthly principal and interest payment. Most banks, they're targeting that minimum debt coverage ratio of 1.25, and of course, the higher, the better, right? Number 5, your liquidity. Finally, the bank will want to know your overall liquidity. How much liquid cash do you have at your disposal? If you're going for that, say, $1.5 million loan again, like we mentioned earlier, and you're putting down $300,000 for the down payment, the bank still wants to see that you have some money in the bank. Really, you should have extra cash in reserve in case you get hit with a boiler breakdown or you have a $15,000 insurance claim or something. That liquidity requirement, it varies from lender to lender. Most lenders like to see 10 to 20% of the loan amount you still have available that's still in the bank. This means you should borrow, if you borrow, like I say, $1 million, you should have a minimum of $100,000 liquid after you close. Other lenders want to see 6 to 12 months of principal and interest payments in the bank and available. So if your monthly payment is, say, $12,000, the lender will want to see that you have $144,000 in your account. Some lenders may even have an escrow requirement. It really depends on the lender and their guidelines, but regardless, they want to make sure you have liquidity. That's super important to them. Keep in mind that if you don't personally have the liquidity, you may be able to partner with someone that does, and that'll help you get that loan by leaning on their liquidity to help you close. Anyway, like I said in the beginning, residential commercial loans are two very different things, and there are many considerations that go into the lender's decision to do that loan. It all goes back to the risk of the loan and the estimation of the lender as well. In the end, if you're looking to pay that loan back, they're going to want to see that the property is a good investment for them, and we're going to cover that in another video, of course. If you want to share your experience of applying to real estate loans that you've done, please leave a comment in below. I'd love to hear from you. I'd love to hear some of the stuff that you guys have done. If you learned something new from this video, give a thumbs up, and check out the podcast, Bulletproof Cash Flow, in iTunes or Stitcher. And of course, subscribe to the YouTube channel as well. We're working so hard and getting new content out for you guys, and we want to help you become successful in the world of multifamily. Anyway, be great. Talk to you soon.